Hello, ladies and gentlemen. This is your teacher Usman Ali, and the video is regarding the basics of the cash flow statement. So, the cash flow statement is the third section of the chapter 4 that we are studying. The previous two sections was related to balance sheet, and this one is related to cash flow statement. So, in this video, I will talk about some of the basic understanding of the cash flow statement, that what a cash flow statement is and how to prepare it, what type of information is needed to prepare a cash flow statement, and in the rest of the videos there are numericals that I will solve regarding the cash flow statement using different scenarios actually. Okay, so with the assumption that you do have a basic understanding of what a cash flow statement is, let's start. So a cash flow statement is such a financial statement, or one of the five financial statements, which actually focuses on the cash inflows and outflows of a company. So organizations always wanted to know that from which sources the cash is coming into the company, and in which sources this company is spending its cash actually. Okay, so a difference between a cash flow statement and an income statement is, in an income statement, if a company is actually using accrual accounting system, so in an income statement is based on the accrual accounting. And if a company records something as its revenues or records something as its expense, so that recordings would be irrespective of the cash received or paid. Whereas in a cash flow statement, we only record those events which or those transactions which do have an effect on the cash, either negatively or positively. Okay, so non-cash transactions, or all those transactions which do not involve any cash with itself, will not be the part of the cash flow statement actually. Okay, so what is a cash flow statement? Once again, a statement which shows cash in and cash out of a company for a period of time. So it obviously has a definite starting point, which is the start of the accounting period or year, and it has a definite ending point as well. And we evaluate the cash in and out status during that time period actually. Okay, now to prepare a cash flow statement, the information that we need is, we need 2 years balance sheet. So we need these 2 years balance sheet because we need the beginning cash balance and we need an ending balances as well. So the ending balance would be our calculation, but we do need the beginning and ending values of the things. Okay, like assets like account receivable, if there are trading securities, if there are like these short-term investments, or if we have inventory or other things, account payable and other long-lived assets, long liabilities, equity. Okay, so we do need the beginning and the ending balances of these, and to have the beginning and ending, we need the balance sheet of 2 years of the same company. Then along with that, we need the current year income statement also. So why we need the current year income statement? Because that would be the starting point if you're preparing a direct or indirect, any form or type of a cash flow statement. So we do need an income statement for the same year for which we are preparing, or we are supposed to prepare the cash flow statement actually. Other than the balance sheet and income statement, we need some information regarding capital gains, capital losses, some special kind of adjusting accounts, purchase sales kind of transactions. So we will talk that in regarding that in a couple of minutes actually. Okay, now this is a basic format of a cash flow statement, comprises of three types of activities: operating activities, investing activities, and financing activities. The basic objective behind classifying a cash flow statement in its different types of activities is actually that we exactly want to know that the cash in and out, what's going on, is exactly related to which group of activities. Is it only related to the operations of the organization, or if it's related to the investments of the organizations, or they are related to the source of financing or source of finances or the financing activities actually. So the objective is actually to know that how much money came in and out, the net value from the operations of the business only, and then how much money came in and out in the investments, and how much money came in and out using the financing activities actually. Now, before we start preparing a cash flow statement, we must familiarize ourselves with some basic rules, the basic rules of cash inflow and outflow actually. Okay, so these are just like if you have obviously you have studied the basic financial accounting or the principles of accounting, and you have studied some rules of debit and credit for all those 5 accounts on which the accounting holds. So we have some rules here as well. So if let's say we are considering assets, okay, so the assets, if it's a cash outflow, it will be considered as an increase. So that would be like this, that if the assets increases, then that would be considered as a cash outflow. Let me give you an example for that. Let's say I have purchased a land. Previously I was having no land. Now I have purchased a land. So by purchasing a land, it means the asset has increased with me actually. Okay, and obviously I must have paid money for that, or if not, then I'm about to pay. So we are not going to focus on about to pay, or we assuming that we have paid, so that would be considered as a cash outflow, because here the cash will become a use of the fund. Okay, likewise, if the asset is decreasing, then there will be a cash inflow. Let's say we had some inventory available and we just sold that inventory on customers on cash. So obviously if I'm selling the inventory gonna decrease because it's going down, and I'm receiving money from the customer, so that would be a source of cash inflow actually. So if the asset increases, that's a cash outflow, and if the asset decreases, that would be a cash inflow. Liabilities and equity work, which you say vice versa to assets. So here, if the liability increases, then that's considered to be a cash inflow. Let me give you an example here. So I took a fresh loan of $10,000 from a bank, and obviously if I've taken a loan right now, so that's going to increase my liability. And if my liability increases, so obviously why it increases, because I took a loan and money is coming into my company, so that's a cash inflow. And if the liability decreases, which means I'm returning back the loan, then that would be considered as a cash outflow actually. Equity and liability behave same. An increase in equity is a cash inflow, and a decrease in the equity is a cash outflow actually. So these are the 3 basic assets that we are focusing on. Okay, now let's focus on some other ones. Those, if you remember, I in my 3rd slide I discussed that in a couple of minutes we will discuss these things. Capital gains. So capital gains could be from selling the long-lived assets or capital assets that we have, or we have long-term investments or short-term investments. So if I sell them, and I sell them at a higher value than its remaining value, so that is considered to be a capital gain. Whereas if I sell them as a low value than its book value, then obviously that would be considered as a capital loss. So if we have a capital gain, then it must be subtracted while adjusting to operating activities. I must minus it. This may slightly confuse you or make you feel a little worried that it's a gain and I'm supposed to subtract that. Why is it so? So it's very simple. When I'm, let's say, using an indirect form of cash flow statement, and I write there net income is equal to, let's suppose, $50,000. So that $50,000 is calculated based on accrual accounting. One thing. Second thing is that $50,000 represents both type of activities, operating activities and non-operating activities actually. So we need to take it out the cash flow which has affected the net income of the company, because this $50,000 include operations of the company and non-operations of the organization as well. Now let's focus on what is a capital gain and a capital loss. So you have studied special income statement items. You have studied income statement in detail actually in the previous chapter as well. If you have a gain or a loss by selling securities, financial securities, long term or short term, or if you have a gain and loss by selling long-lived assets, these gains or losses are considered to be as non-operating events. They are not the integral part of the operations of the company. So obviously, if it is a gain, capital gain, then it means that capital gain must be adjusted. Adjusted to what? Adjusted to the net income that was calculated. So if in my company shows a net income of $50,000 And my very first line, you will see that in the coming numericals as well. Our very first line in the indirect method would be that when I write there operating activities heading, my very first word would be net income is equal to $50,000, let's say. So this $50,000 must be adjusted for the operating and non-operating activities, not the operating, okay, or non-operating activities. Capital gain is a non-operating activity, so it should be adjusted for that. And one another thing it should be adjusted for is actually the depreciation expense actually, and the amortization and depletion. Now you do know that depreciation is related to tangible assets, okay, and amortization is related to intangible assets, and depletion is related to natural resources. Now, if you have any form of such expense present in your income statement, all such forms are actually called as non-cash expenses. So if I have written depreciation expense in the operating expenses section of my income statement, so obviously it is such an expense for which neither I have paid the money this year, nor I am supposed to pay in the coming years as well. So it's a non-cash expense, and such an expense which do not have any effect on cash. But as the income statement focuses on the accrual accounting system, so we have already subtracted depreciation there. Now we are supposed to adjust it. If I have already subtracted something inside the income statement, and according to the cash flow statement, it is not supposed to be subtracted because it is nothing to a cash flow statement. So the adjustment of that would be, if already subtracted, I'm going to plus it back. So whenever you see depreciation expense, amortization expense, depletion expense, there shouldn't be any doubt. And right away you should add it back to the operating activities because it was subtracted in the income statement from the operations of the company. And according to cash flow statement, it is not even a transaction as well. So I hope this will a bit help you here. And obviously when you do numericals, you will have a full command on these other things, okay, because we have a numerical on capital gain. We will use capital losses, and obviously depreciation will be used in all the, and amortization as well will be used in almost all the numericals actually. So this is it regarding the basics of the cash flow statement. I hope you got the basic understanding. So I'm waiting for you to join me in the numericals to get a full concept of the thing. Thank you very much, ladies and gentlemen. Stay safe.